Have you ever just picked up a product, looked at the price tag, and wondered, how much did this actually cost to make? I mean, it sounds like literally the most fundamental question in business, right? Whether you're running some massive multinational manufacturing operation or you've just got a weekend side hustle selling crafts out of your garage, you absolutely have to know your costs. But here's the crazy part. The answer to that seemingly simple question, it depends entirely on who's asking it and exactly how they're doing the math. So let's dive into this, because the way a company calculates its costs can completely transform how its profitability looks on paper.
All right, welcome to this explainer. Today, our goal is to take some seriously complex accounting concepts and completely demystify them. We're going to do this by looking through two very different analytical lenses. We'll explore how manufacturing costs get assigned to products and figure out why two different accountants can look at the exact same factory, the same assembly line, the exact same raw materials, and somehow come up with two totally different profit numbers at the end of the month. I promise it's not magic and nobody is making a mistake. It really just comes down to a matter of perspective.
So here is our roadmap for today. First up, the costing methods dilemma. Then, we'll compare gross versus contribution margins. Third, absorption versus variable costing. Fourth, we'll see the math in action. Fifth, variances. Basically, what happens when expectation meets reality. And finally, we'll wrap up with how to choose the right lens.
Okay, kicking things off with Section 1, the costing methods dilemma. So, the core problem every single business faces is figuring out how to cover its fixed costs. We're talking about the heavy hitters here: factory rent, insurance premiums, equipment leases. These are the bills that do not change whether you make one single item or a million items. You've got to pay them either way. But how you analyze those costs, well, that changes drastically depending on who you're reporting to. On one side, you have the internal manager. This person is trying to survive the day-to-day. They're on the ground making these rapid-fire decisions about pricing, calculating break-even points, and deciding, should we take on this massive special order at a discount? On the flip side, we have the external investor, tax authorities, and the incredibly strict rules of GAAP, generally accepted accounting principles. These folks aren't running the factory floor. They demand standardized, comparable compliance. And because these two stakeholders need entirely different things, they literally have to use different accounting lenses to look at the exact same business.
Moving right along to Section 2, gross versus contribution margins.
Let's break this down. Contribution margin is just your sales minus your variable costs. Boom, that's it. It tells you exactly how much money each individual sale is contributing toward paying off that fixed overhead we just talked about. This metric is an absolute lifeline for internal managers making quick pricing decisions because it strips away all the noise of rent and insurance. It just answers one simple question. If I sell one more unit, how much actual cash does it generate to keep the lights on? Gross margin, on the other hand, takes your sales and subtracts the total cost of goods sold, which bundles in both those variable costs and the fixed manufacturing costs. So the really crucial takeaway here is that your contribution margin is almost always going to be higher than your gross margin because you're deducting fewer costs. Really grasping the difference between these two is the secret to understanding how a business stays afloat on the inside versus how it reports its success to the outside world.
All right, Section 3, absorption versus variable costing.
This brings us directly to absorption costing. Now, this is the strict standard required for those external reports we mentioned. It's often called full costing, and for good reason. It quite literally absorbs every single manufacturing cost into the final product, like a giant financial sponge. Just think about the sheer magnitude of that for a second. Direct materials? Yep, absorbed. Direct labor? You bet. Variable overhead, like the electricity powering the assembly line? Yes. Fixed overhead, like the monthly factory rent or the depreciation on those massive machines? Absolutely absorbed too. According to GAAP, this is the only acceptable way to determine the quote-unquote true cost of producing an item, making sure every production cost perfectly matches up with the revenue it generates when you finally make the sale.
But, how do we actually calculate that absorption in the real world? Well, the folks over at NetSuite outline a pretty brilliant, structured, three-step procedure for this. Step 1, allocation. You gather up your general ledger accounts and dump them into distinct cost pools, like grouping every single factory labor cost together into one big bucket. Step 2, figure out your activity measure. This just means finding a logical driver for those costs, like counting up the total units produced, or maybe the machine hours used that month. Finally, Step 3, calculate. You take that total cost pool from Step 1, divide it by the activity measure from Step 2, and voila, you get a highly precise per unit cost. Honestly, it sounds incredibly neat and tidy on a whiteboard, doesn't it? Everything just perfectly fitting into its own little box. Which leads us perfectly into Section 4, the math in action.
Let's look at an awesome example from Vedant 2 about a pen business. Imagine we sell 1,000 pens at 20 rupees each. Our sales? Exactly 20,000 rupees. Now the variable costs, the physical stuff like the ink and the plastic, that runs us 12 rupees for every single pen. So 1,000 pens times 12 rupees, that gives us 12,000 rupees in total variable costs. And let's say our fixed costs, like paying the factory supervisor, sit solidly at 4,000 rupees. Now let's just pause and run those two different margin formulas. Contribution margin is sales minus variable costs, right? So 20,000 minus 12,000, that leaves us with 8,000 rupees. That 8,000 tells the internal manager, hey, we've got 8,000 rupees available to cover our 4,000 rupees of fixed costs and hopefully turn a nice profit. But the gross margin subtracts all costs, both variable and fixed. That leaves us with just 4,000 rupees. It is the exact same business, the exact same box of pens, but a dramatically different story about profitability depending on the lens you use.
Here's another great one from NetSuite. A t-shirt maker called Tees BT. They crank out exactly 15,000 shirts. Each shirt takes $1 of direct materials and labor, plus 50 cents of variable overhead just to run the sewing machines. But they also have $30,000 in monthly fixed overhead. Under the strict rules of absorption costing, we absolutely cannot ignore that $30,000. We have to divide it evenly across those 15,000 shirts. That works out to exactly $2 of fixed overhead applied to every single shirt. Add it all together, $1 of direct costs plus 50 cents variable plus that $2 fixed burden equals an absorption cost of exactly $3.50 per unit. Everything is flawlessly accounted for. Not a single cent is left behind.
All right, Section 5, Variances, Expectation versus Reality.
So, what happens when real life steps in and completely ruins our perfect whiteboard math? Total chaos, that's what. This is where variances come into play. Variances basically measure the gap between the results a business rigorously plans for and the messy results they actually get at the end of the month. It's that terrifying moment when actual financials come crashing in and flip our meticulously crafted budgets totally upside down. All that tidy math we just did, it suddenly has to survive the completely unpredictable nature of the real world. Let's look at what's called a fixed overhead expenditure variance. Say you budget £100,000 for your annual factory rent. You've built your entire pricing model around that specific number. But then, out of nowhere, your landlord unexpectedly hikes the rent and you end up actually spending £120,000. Ouch. That gives you an adverse expenditure variance of £20,000. Your costs shot up and your expected profits just took a direct, unmitigated hit. If you've ever run a small business or had to manage a commercial lease, you know the sheer panic of this exact scenario. It literally throws all your previous absorption math right out the window.
But hey, reality can flip the other way too. It's not always a disaster. Imagine if, in that exact same factory, with that crazy expensive rent, you initially planned to make 50,000 units. But, things just clicked, the team was on fire, and you actually produced 55,000 units. You just squeezed 5,000 extra units out of a factory you were already paying for. At our standard absorption rate of £2 per unit, that creates a £10,000 favorable volume variance. You maximize the output of the space you had, effectively turning a fixed burden into a huge competitive advantage.
And accountants, they don't just stop at that top-line number. They want the human story behind it. That favorable volume variance of 5,000 extra units, we can actually break that down further. Did we get those units because of an efficiency variance, like meaning the factory staff just worked faster and way more skillfully than we expected? Or was it a capacity variance, meaning the staff simply worked more hours or took on extra shifts to muscle the job done? By breaking the variance down into these specific buckets, management can step away from the spreadsheet and finally understand exactly what's happening on the floor with their actual human workforce.
Finally, Section 6, Choosing the Right Lens.
So now that we've deeply understand the math, the differing margins, and the utter chaos of variances, how do we actually use this? Well, here is the absolute most crucial takeaway you should commit to memory today. You use absorption costing for the outside world, external reporting, strict GAAP compliance, doing your taxes, because it captures the full absorbed cost of inventory sitting on your balance sheet. Investors demand this view. But if you're making internal decisions, like trying to price a last-minute special order, figuring out your break-even point to survive a painfully slow month, or judging the true efficiency of your team, you absolutely must rely on marginal or variable costing. It is the only lens that shows you the immediate cash impact of your day-to-day choices.
Look, at the end of the day, the numbers on a spreadsheet are just a representation of reality bent through whichever accounting lens you choose to use.
The lens literally shapes the narrative. So I want to leave you with this final thought to ponder for your own business or career. Are you pricing your products merely to survive today by just covering your variable costs? Or are you utilizing full absorption costing to ensure you can build sustainable profits and actually grow tomorrow? Thanks so much for hanging out with me for this explainer. And remember, always keep looking closely at the numbers behind the business. Catch you next time.